Hi traders, welcome to this trade secret tutorial on chart patterns. There are a number of well-known chart patterns that can give you good clues to possible future direction of price. They're found in all markets and time frames, and basically these patterns can be used to either understand market direction or try and anticipate market direction to support existing trades, or if you want you can try and trade the setups themselves. And obviously some patterns are easier to trade than others depending on your own personal risk reward criteria. So patterns broadly fall into two main categories. We've got the continuation patterns, and the major groups are channels, ascending triangle, descending triangle and symmetrical triangle, and then we've got the reversal patterns, and these would include the double top or double bottom, head and shoulders, inverted head and shoulders, and the rising and falling wedge. And there are separate tutorials actually on all the continuation patterns, simply because I don't recommend, or most people don't recommend, trading against the trend. So I prefer to trade continuation patterns, and for that reason alone I've got some more detailed stuff on trading those continuation patterns. Anyway, moving on. So let's have a look at those continuation patterns very briefly. So we've got the channel or a horizontal consolidation. So if our trend is upwards, it comes up into the channel, we form a resistance layer, a support layer, and the trade is basically a break of that resistance continuing the trend. And we generally enter on the break of the resistance, and typically the stop loss will go behind the support level that's created. The symmetrical triangle, again in an uptrend, basically we form a succession of lower highs, but at the same time also higher lows, and this gives us a triangle, and typically we enter on the break of the triangle on the north side with our stop loss on the other side of the triangle back side. Again in an uptrend. Obviously for shorts everything's reversed. Continuation patterns continued. So the ascending triangle, it's a bit like a channel, only this time we've got a clear resistance level formed, but we've got a series of higher lows, and that is really creating some pressure. It's a bit like a tube of toothpaste, and eventually it squeezes up long, so in an uptrend. And the brother to this, or sister, is the descending triangle. So we're coming down in a downtrend, we form a support level, ever lower highs, squeeze, and it fires short. Entry on the break at the support level, stop loss back behind the triangle side or a suitable swing high. So looking at the reversal patterns now. So the double top, and it is what it says. Basically we've got a move in an uptrend, it forms one attempt, comes down, forms another attempt, so it's almost starting to form a channel, but it's basically two attempts separated in time. They should be discernible, but it breaks and falls beneath what we call the neckline. So this lower line or support line is what the neckline is, and if you were trading this pattern then you enter on the break of that neckline, stop loss obviously back behind the top. Its brother is obviously the double bottom. So we're in a downtrend, we come down, we test a support level again, so two attempts, and then on the break of the neckline going long, we go long. Entry obviously on the break of that neckline, stop loss back beneath the double bottom. Now there are also triple bottoms and triple tops, but I'm not going to go into that. Really the double top and double bottom is the most frequent or most well-known pattern. So continuing on, we've got the head and shoulders. Head and shoulders, what we're looking for is basically a peak, a higher peak, and then a lower peak. So shoulder, head, shoulder, and then the entry for this trade is on break of the neckline. Now the neckline can be slanted. We're literally just connecting the two in between lows to create a line there. We enter short on the break of that neckline. Stop loss needs to go back behind the head or possibly the right shoulder, depending on your risk appetite. Sometimes it's difficult to find these, and when you do see them, the risk to reward doesn't really make it worthwhile. So it's often worth using just an indication that possibly trend is changing. Its brother is the inverted head and shoulders, so exact duplicate, just in reverse. So the left shoulder is a trough, a lower trough for the head, and then a higher trough for the right shoulder. And again we're looking at the break of the neckline to go long, stop loss beneath the low. And then the rising wedge, what we're looking at here in an uptrend is a series of higher highs, but they're not much higher than the last one, whereas the lows are a little bit higher, and that gives us this wedge formation. And what happens is, because we're failing to create higher highs, there's a bit of a pressure, and eventually we have capitulation, and we enter this really on the break of the lower trend line of the supporting trend line, and we go short here, stop loss back behind the recent swing high. And its brother is the falling wedge. So in an existing downtrend, we can see we can form our two lines there. We're not really forming radically lower lows, i.e. the selling pressure is running out, and again enter on the break of the trend line and go long. So let's have a look at some of these in reality. So this is Euro GBP on a 4-hour chart, and this is a very, very beautiful, very clear head and shoulders. We've got left shoulder, dip, head, further dip, right shoulder, and then dip again, and we can see we've got a nice angled neckline. Now purists will say that you really want an angled neckline, and you want it angled in the direction that you're going. So obviously if we're going short, as we would be in a head and shoulder situation, then we'd like our again the right trough to be a bit lower than the left trough. Okay, so this is GBP on a daily chart, and we're looking at a good double bottom here. So we go nice move down, tests that level once, bounces back up, tests it again, and then on the break of that neckline we can go long if we wanted to, if that fitted our risk reward criteria in our individual trading style. And then a good example of a wedge, we've got a falling wedge on the Canadian 4-hour. Now we can see that we break the wedge, but it doesn't really go long here. What it's doing is it just refuses to go any further down and starts consolidating, and that's why I tend not to trade the reversal patterns too much, because they are in effect counter trend, and we always really want to trade with the trend. But it's good to spot, and it can alert you that possibly going short, if you were looking for a short trade, it may not be such a good idea. Either downward pressure is not there, or at least not in the short term. So chart pattern summary. Chart patterns, powerful tools, can be used as market direction indicators, can be traded in themselves if the risk to reward ratio works for you. Found in all markets and time frames. Continuation patterns are more common and easier to spot. Certainly that's what I feel anyway. You know, in channels and ascending triangles, they do occur on a regular basis, and you know, I think that they're easier to spot certainly. And continuation patterns also perhaps easier to trade as they're more intuitive, because they are with trend setups. So mentally it's a lot easier to trade something when you feel you are going in the major market direction, whereas getting your head around a reversal and shorting something that looks quite bullish to the uninitiated is a bit more difficult. So I tend to trade continuation patterns. They work for me. Okay, thanks very much indeed.